Good
So we,
morning.
good morning, good morning. So we want to welcome you to this month's legacy class titled Insurance. My name is Teresa McDuffie, and I am the Legacy Program Director. We are so glad that you could join us today. So happy that you could be with us. This is a wonderful, timely topic that I believe we're going to have a really great discussion. We have two dynamic speakers geared up for you today. We have Clayton C.J. Madison. He is the owner of Madison Life. And we also have Miss Rosalind Glenn. She is president and CEO of Destiny Wealth Advisors and Consulting, LLC. So before I do introduce our speakers, I just want to let you know that we do have a moderator that will be asking your questions for you. So if you go ahead and add your questions in the chat, someone will be asking those questions for you as the speaker takes breaks. So we will see those questions. If you have anything you think of, go ahead and put that in the chat and we'll ask those questions for you. Okay, so I'm going to introduce our speakers today. First, we have again Clayton C.J. Madison. He is the owner of Madison Life, which was established in 2000. He specializes in insurance for seniors, but he can serve all life insurance needs for those ages 0 to 85 years old. Welcome, Mr. Madison.
Good
We
morning.
Good morning. We also have Miss Rosalind Glenn. She is president of Destiny Wealth Advisors and Consulting LLC. With more than 30 years of financial experience, she assists individuals, businesses, churches, and nonprofit organizations in developing strategies to ensure longevity and sustainability. She is a service certified professional and registered investment advisor with Prucro Securities LLC, providing services to her clients as a representative of Prudential Financial Planning Services. Welcome, Ms. Glenn.
Thank you for having me. I'm happy to be here.
Yes. So we got a jam-packed class, so we want to start off with Mr. Madison.
Okay. Well, good morning again, everybody. And I'm going to be short and brief with what I want to talk about as far as the life insurance. Um, as Miss Teresa said, that I serve seniors, but I um, enroll all ages, zero to actually the age is 0 to 90. Okay, there's a company out there that can enroll a person from 0 to 90. Okay, so the subject is whole life versus term life. Okay, so what I'm gonna do, I'm gonna give you a quick definition of the two and a little bit of how they're made up. So term life insurance is really what it says. It's basically a term policy that's basically broken down into increments of 5 years, 10 years, 15, 20, all up to 30-year increments. And the thing about term insurance is it is a 5 years. For the 5 years, it's level premium. The premium will stay the same. But at the end of the starting the 6 year, the premium is going to go up. Okay. And it's going to go up every 5 years. The same with a 20-year term. At the end of the 20 years, that premium going to balloon and go into what's called annualized premium, which means the premium will go up every month. Okay. Now, when you talk about term insurance, you basically all you're paying for is the insurance. There's no growth as far as cash growing in the policy or anything like that. Okay, and for the most part, people get term insurance for short-term coverage. Okay, they get it for if they bought a house and they need $100,000 or 500,000, but it's only for a temporary time frame. Now, when you talk about whole life is basically the same as far as the word whole life. Okay, and in the insurance industry, the word permanent is basically what we're talking about when we say whole life. Okay, because whole life is the life insurance that you will get and have for the duration of your lifetime. Okay, now the thing about whole life is it accumulates cash value. Okay, and in some cases, some type of whole life policies, they actually pay a dividend. Okay, so whole life is long term because the premiums are set at one price for that particular age of the person, and it will never change through the life of the policy. And the coverage, whatever the coverage is, the coverage will never change. Okay, so if you, as long as you're paying your premium, the that premium that you're paying, that amount of coverage that you have, it'll be there, and it will never change through the lifetime of the policy. Okay. Um, let's see, something else I was going to mention about whole life, because you have different type of whole lives. The two that is most popularly used in the market is the participating and the non-participating. Okay, and let me just speak on that real quick. Participating whole life is the type that basically the company will make you, the policy holder, a part of owning the company. You know, you're under contract when you do the policy, and as the company grows financially and if they accumulate growth in their through the years, they'll give you a dividend. When they make money, they'll share with the policyholder. Okay, and they'll either pay it to you at the end of the year, or they'll take and do what's called paid up addition. Well, they'll reinvest the dividend into the whole life policy, which will allow the policy death benefit to actually grow. And the one difference between that and term has none of those features. Okay, with term insurance, if you got 100,000, and whatever the cost is good for that set period of years. Okay. Any questions? No questions?
Yes, there's a question in the chat.
Okay.
In what specific situations would you recommend term versus whole life?
Okay, so a lot of my young clients, or either young or a client who may have purchased a home, a person who may want to leave X amount of dollars in life insurance to a person for a certain amount of years, I recommend they get a term, because a lot of times, as far as like a homeowner, they buy a house that's $300,000 and they want to insure themselves for the duration of a time frame. So if they're on a 30-year mortgage, then they'll do a 30-year term. Okay. And then at the end of the term, which is normally the same time frame of where the mortgage will end, the term is going to basically expire anyway. Okay. So that's one case. And then some of my clients out, who say they want to put insurance on their children who's 18 and they just want to do a term because they don't want to pay a lot. And that's the other thing I didn't mention, is that the cost of term insurance is much cheaper than the cost of whole life, because whole life, you're paying a premium and you're also paying towards your cash value. Term insurance, you're just paying the premium. But for the most part, it's for a person who just, they don't want life insurance for their whole life. They just want it for a certain amount of time and they don't want to pay a lot of money. So I recommend a term policy. That answer the question for the person?
Mhm. We have another question. What are the deltas in premium between the whole life insurance versus term?
Say it again.
What are the deltas in the cost of whole life versus term? Typically,
Okay.
what's the difference do you see?
Okay, so for one, term insurance is going to be much cheaper because you're only paying for the life insurance. Okay. Whole life policies, I think I mentioned it, you have your premium for the life insurance. Then you have what the premium is a bundle that you're paying, where part of it is for the life insurance, part of it is the company will take and use it, for your cash value. Okay. Part of it is for administrative charges. Part of it is everybody pays what's called a policy fee. Okay, it's an annualized fee. But whole life policies, because you had that bundle of different charges that go to different areas. With term insurance, because it doesn't have any cash value, so you don't have any type of premium going towards a cash value. Okay, and it's again, it's only temporary coverage. Okay, so you have a bundle of charges within your premium for the whole life, and then with the term, you just basically have one charge, which is for the life insurance itself. Did that explain the question? Is it good?
Yes.
Okay. But yeah, the thing about when it comes down to a person deciding the type of coverage they need, I myself, in my years of being in this industry, I've when it comes into my younger generation, and let's say a husband and wife, and they just bought a house together, I would always say, you get the large amount of coverage to cover the house in case something happens prematurely to either one of you. It don't just have to be the husband, but also recommend a whole life policy. Okay. Now, I know I don't have time, but there's one type of whole life policy called the universal life. Okay. And the universal life is set up for long-term coverage also. And so I always recommend that person who's 35 and just got married, okay, you need 200,000 or 500,000. Let's do a term, but let's also look at if you want to also do a policy, a long-term policy, and because you're young, you can do a policy, a whole life policy, where you can do it that has a participating feature. Okay, so that while you have the whole life policy, the policy is building cash value and the policy is also paying dividend. So at the end of the 30 years, you already have your whole life in place. And it's in place while you're young, it's in place while you're 35 instead of now you're 65 and you got to start over. because remember, the term is only good for 30 years. And so now you're in a whole life policy because you still want to consider you having life insurance when you, even though you're 35, you want to consider having a long-term policy, because if you may live to be 85 or 95. And if you don't have your financials in place to cover that, you're going to need that life insurance. That makes sense? Hello?
Quick,
Yes.
one last question. Do you recommend for those people who do have their finances in order to go with a term versus a whole life?
Say it again.
Do you recommend for people who have their financial house in order to go with term life over whole life insurance?
If you have your financial health in order, I would recommend term. And that's simply because if you may need 500,000, something happens to you, and you don't have 500,000 in the bank, because you getting this term for 20 years or 30 years. So yes, I would recommend a term as opposed to a whole life, because you don't really need, well, depending on your financial situation, you may not need to build a whole life policy if your financial future is looking good and you already got it set up to where, I'm investing and these investments going to accumulate value that will cover my, I have the expenses or to cover my funeral and burial. I would definitely recommend term. And term insurance, as far as building your term policies, it's based on every individual person. Everybody have their own personal needs, whether it's life insurance and they have their own personal financial established growth and everything. And so I always look at, do the needs analysis and let's see where you're at, but yes, term would definitely be what I would recommend.
All right. Any other questions? That was awesome information. Awesome. And this information is going to make the difference in whether you save money or not, because you will know which type of policy you need to fit you wherever you are in life. Any
Amen.
other questions? Okay, feel free to contact Mr. Madison in regards to any questions that you may have. If you want to send an email to the Legacy email address, you can do that as well. All right. So our next speaker, Miss Rosalind Glenn, she's going to come before you next and provide some more information on insurance.
Thank you very much. And I am right now in the process of sharing my screen. You guys have to let me know if you can actually see it.
Yes.
Are seeing.
We can see it.
I'm gonna put it
Yep.
in slideshow presentation here. Give me 1 second. All right, how's that? And now tell me, are you seeing the actual slideshow or are you seeing it with my notes as well? Tell me which part are you seeing?
The actual slides.
Okay, great. So technology, it is a wonderful thing, right?
Yes, yes.
Mr. CJ did an excellent job of explaining and talking about the difference in the term and the whole life. What I hope to add to this conversation is just some other aspects about life insurance and why you might consider using it. as a financial planner, I believe that everybody needs insurance for the whole of your life. So whether you start as a young person, which I generally recommend because the cost of insurance is much cheaper. Most parents think, well, I don't need to insure my children, but I have a difference of opinion. I think that if you insure your children, if you put a policy on a child when they are young to guarantee their insurability, you can use that life insurance not only for covering and providing a death benefit for them, but I also have clients that use life insurance as a means of funding education for their children because of the cash value build up in it. And the benefit of doing it that way is that that money comes to you tax-free. You're able to save it tax-free. You're able to use it for education tax-free. And so there are some other benefits of life insurance other than just the death benefit. So the aspects of protection, because that's what life insurance does. It provides protection for you and your family. If you are a 2-income household and one of those income goes away, can you still maintain your household at the same level? Likely not. And so we've got to stop thinking about life insurance just in terms of something to bury me with. It's called life insurance. So life insurance is for the living. So when you're thinking about, the amount of coverage that you might need, think about replacing one of those salaries, for a certain period of time. So if the salary is a $50,000 salary, you may think about replacing that salary for, at least, the first 5 years to be able to make sure that your family can sustain itself. So in that instance, you would need about $250,000 worth of coverage. And to Mr. CJ's point, you may think about getting that in a term policy because you only need to replace that income for that period of time. I am a firm believer in every one of my clients at a minimum have $100,000 worth of permanent coverage because you are going to need coverage the whole of your life. And so I am more of a fan of permanent coverage for that reason, and then blending it with some term coverage to be able to meet the other needs, like providing for paying off a mortgage once you, in that 30-year terms, as he mentioned, or providing for your children. Once they're born, you want them to at least be able to get to 18. And so you may get just a 20-year policy when your children are born to be able to provide some resources for somebody to care for them in the event of your premature demise. And so when you're thinking about the aspects of life insurance, don't think about it just from a death benefit perspective, but think about it also from a life insurance. And also think about how you can use it for other means. I have clients that use life insurance for the purpose of retirement because they have maxed out all of their other opportunities to save for retirement. Generally, that is reserved for what we call high income earners who can't put any more money in their 401k, who can't add any more money to their IRAs, but they still want to save for retirement. So they're able to use life insurance in that matter. Now, let me give the disclaimer is that there still has to be a death benefit need. So we can't sell life insurance for the purpose of investing, but we can give the other features and benefits that come along with life insurance. Because another feature when we start talking about creating the legacy piece is the fact that life insurance proceeds are generally tax-free. And so as Mr. CJ was explaining, you pay into a permanent policy, you pay the premium into the policy, but you also pay a little bit more. And what the insurance company is doing with that more that you're paying is that they're investing it. And so it is growing. And what they're saying, because we're getting the benefit of this, we're also going to share some of this growth with you. So that's where the dividends come in at. And in a universal life policy, the insurance company tells you how much they're going to pay you, but you also have the opportunity for what we call a variable universal life policy, where you get to choose the investments that you want your monies to be put in so that you have the opportunity for more growth. So whenever we're thinking about life insurance, we definitely want to think about it more than just something to bury me with. You know, it will protect your loved ones. It'll provide cash when you need it. It's generally income free. And generally that death benefit is always going to be there. Now, I'm sure some of you have heard stories about how people have paid into policies, you know, over a lifetime. And then, you know, in their older age and they pass away and they go to get the premium and there's no death benefit. Well, you got to be sure that you're reading all of the features of the policies, because some policies do say you pay into this policy over these years, but at the point that you turn a certain age, that death benefit could not be there. And so you want to make sure you're reading and understanding the types of policies that you are getting. And you want to make sure that they're going to be with you the whole of your life. Do you need life insurance? Absolutely, right? Everybody needs life insurance. There's not these are my thoughts, having 30 years in this business, working with people. Everybody needs life insurance. I don't care what level of assets you have. You can self-insure, but think about whether or not you want to use your assets to self-insure, right? You want to be able to leave your assets as legacy building for making sure that your family is taken care of. If you are a business owner, making sure that your business can continue if that is your desire. If you have a succession plan that you put in place, how you're going to transition your business, you need to have life insurance potentially in place to make sure that your business can continue to sustain itself until you are you have actually dissolved the business or transferred that business into the hands of someone else. And so I am, again, a fan and a proponent of everybody needs life insurance. And I am a proponent of putting life insurance on children while they're young and in good health, and their insurability is guaranteed. In our community, we are known for waiting until we are older, which drives what the insurance premium will be. We've got, diabetes, high cholesterol, high blood pressure, which all of those factors play into the cost of your premium, because they're generally, in most insurance carriers, have 6 different levels that they choose from preferred best rating all the way down to the smoker rating. If you are a smoker, you end up paying more for insurance than you would if you were a non-smoker. The type of lifestyle that you live, if you are an adventurous person and you're jumping out of airplanes and living on the wild side, you generally end up paying more for insurance because of the type of lifestyle that you choose. So all of these things you can kind of think about as you're thinking about life insurance and what you need. And again, the reason why I think everybody needs life insurance for the whole of your life is for these reasons. You want your family to be able to maintain their same standard of living. So can they cover their daily living expenses if an income goes away? Can they continue to live in the home that you have provided if an income goes away? Can your children still be educated if one of those income goes away? We do need it for the final expenses because it's on average now. Funeral expenses are estimated at about $15,000. A lot of people are doing cremation now and that sort of thing, so it may not be as much, but it just depends on where you are, what your beliefs are about how you want to leave the earth realm. And so you want to be mindful of all of that. But life insurance, can be used for retirement. And most high income earners like this because it is one of those tax-free opportunities, and most of us are trying to manage our tax liability, right? So we don't have to pay so much in taxes, and using life insurance to help supplement your retirement. It should not be your only retirement, but it can certainly supplement your retirement. And of course, the income replacement and the debt elimination. These are all reasons, because you don't want to leave your family with a lot of debt. And while you can't be responsible for are charged with paying another person's debt, the ownership is what matters when we start talking about, you know, whether or not we have to pay a person's debt. So let me explain what I mean by that. If there is a home and it has both persons' name on it, husband and wife passes away, then husband cannot do anything with that property as long as that half of that property belongs to wife. So the creditors can come after that asset to pay for whatever is needed for the wife, because half of that value was hers. And so while they're not forcing you to take on the debt or forcing the spouse to take on the debt, they are saying what you're going to have to do is refinance this home, get it in your name, and then pay us her half. And so that's where families get kind of a little bit intertwined into, you know, saying they're trying to make me pay somebody else's debt. Ownership is what matters, which, let me say here parenthetically, you want to make sure that you've got, you know, the proper names, and if you have property, you want it listed as joint with rights of survivorship so that it transfers easily. If you have bank accounts, you want to make sure that you've got transfer on death or payable on death names on those accounts so that you can transfer that easy. And that is a reason for life insurance, because with the life insurance, then you pay that her half of the debt off, get the property retitled, and now everything is all settled and well. And so, you know, we really got to think about those things. And I do have, and I don't think I sent this to you guys, but I am happy to share a document. I'll share it with Teresa and with Greta, and they can share it with the rest of you. It's just a quick estimator that we use to kind of help you think about how much life insurance you might need. Now, I say to people when they use this quick estimator, it's going to give you a crazy number, because most of us need more than $1 million worth of coverage if we have families. I mean, it's just kind of based on that. But we do more realistic, because you know your lifestyle is relative to you and your family. It's relative to what you want to accomplish, what legacy you want to leave. Is relative to whether or not one of the things that is happening for me right now is, you know, the roles are changing with our parents, right? They're older, and so now I'm having to take on some responsibilities of making sure that they're okay. So I want to make sure that if I should predecease them, that somebody is still going to take care of them. So that made me say, Raj, you may need to go back and up your insurance coverage for this season right now, or add an additional term policy to be able to make sure that my parents are still going to be okay. And somebody is still going to provide the same level of care for them that I'm providing for them in the event of my, you know, my leaving here before they leave here. And so those are things to think about. I'm going to stop talking for a second and see if there are questions while I flip through and get to the next part of these, because I don't want to cover the things that have already been covered. Are there questions?
Yes, Ms. Glenn, we have 2 questions in the chat. So the first question is, should you have life insurance on your adult kids?
So I think you should make your adult kids get their own life insurance policy. However, if they are not, I'm going to use the term as responsible, absolutely, because that will fall back on you, right? If your children, your adult children, are not married and they don't have spouses, the next of kin is where that falls, which generally means it's the parents. However, I am not a proponent of parents taking care of adult children. We have to teach all of us to bear our own responsibilities in this earth realm. And so encouraging them, sharing why they need it, helping them to get it, and even encouraging them, they can get it and make you the beneficiary of it, right? And then you can carry out their wishes, because we got to start having these conversations. We don't like to have them, but what of your life, right? When you leave here, what do you want to happen? Do you want to leave here with somebody having to call the family up and say, hey, we need you to bring a check because this person has passed away, they had no coverage, and now we got to bury them? And so that's the burden that you want to leave on your family. You don't want to do that. And so we've got to start having these real conversations about that. But should you as a parent cover an adult child? No. But you should strongly encourage your adult children to carry coverage on themselves. And as I said, if they're just demonstrating, I'm going to say irresponsible behavior, then by all means, you may end up doing that. But here's the thing, you can't put coverage on an adult person without their consent. So they are still going to have to participate in the process. They're still going to have to go through the underwriting process, which I'm going to talk about here in a little bit, because I think everybody needs to understand that there is a process of getting coverage as well. And so you can't put coverage on them without their participation.
All right. The second question, Ms. Glenn, was, is long-term care insurance good as you get older?
So thank you for asking that question, because what I am leading into right here is life insurance. So I am not a fan of standalone long-term care policies, because you can get a long-term care policy. I am a proponent that everybody needs to provide for long-term care in their lifetime. And you can use life insurance to be able to do that. Insurance companies are getting a little bit wiser in terms of the types of policies that they're offering, and they offer features or riders that you can purchase to go along with your life insurance that will allow you to access your death benefit prior to your decease if you need that coverage for long-term care. And the way we're seeing the rise of dementia and Alzheimer's, there is likely going to be some level of long-term care needed. And there is a false thought that Medicare provides coverage for long-term care. It does not. Medicare provides coverage for hospice, end of life, and that is it. So if you are still living and but you need some assistance, you're unable to do what we call at least 2 of the 6 daily activities of living: bathing yourself, dressing yourself, feeding yourself, using the bathroom, transporting yourself. I always forget that 6th one, but there's 6 of them. If you're unable to do at least 2 of those things, then you could potentially need long-term care. And so that is another reason for looking at some type of permanent insurance solution that also provides long-term care coverage in the event that you need it. The benefit of doing it with an insurance policy rather than purchasing a long-term care policy standalone is cost. Because if you purchase a standalone policy and you never need it, then it's just like car insurance. You're glad you paid for it and it was there when you needed it. But if you don't need it, then nobody gets the benefit of that money that you spent. And long-term care is not cheap. It depending on when you get it, you're going to be paying anywhere from $400 to, I've seen as high as $800 or $900 a month. And that coverage increases as you age. And so that is why I'm not a fan of it. However, adding a rider to an insurance policy ensures that you have long-term care coverage. So you do, and I am a proponent of making sure that you provide for that goal and objective of providing for long-term care. But I recommend you do it through life insurance to be able to have it when you need it. And again, the benefit of doing it through the long-term care or doing it through the insurance is that somebody is going to get a benefit of that money. Either you while you're living, even though you're paying that premium, or your beneficiary once you are deceased, because there will be a death benefit that will be left over as well.
All right, Ms. Lynn, we have another question. Could you go back to the slide with the salary breakdown, and could you go into some detail on it?
Okay. All right. So we generally look at this when we're asking you to value what your salary means to your family. So when I was speaking about the fact that if there is a 2-income household and the household income annually, and I'll just pick one off of these, this, is $50,000 because that's what I said. Your salary earned until retirement could equal a total of about $900,000. So we're just calculating that salary over, a 40-year, 30-year, 20-year time frame, kind of, sort of. So it kind of helps you to know how much replacement costs you may be looking at and for how long, if that salary goes away, so that your income, so that your family can still maintain the standard of living that you have set for them. So it's asking you the question, what is the value of your salary to your family? Really, what does your salary mean to your family? And it's encouraging you to think about using life insurance to make sure that if there is a gap in that, because that salary is no longer there, because as long as you're alive and you're making it, then all is well. Everything is right. You're going to get that money in. You're going to allocate it properly. You're going to meet the goals and objectives for your family. But if you're not here to do that, what is the value of that to your family? Does that make sense? Does everybody kind of understand? And this is just the means of helping you to think about how much coverage you may want to consider. And it takes into effect that, you may get increases over the years. You may invest that money over the years, and it would grow for you. So that's what this slide is referencing.
All right, there are no more questions at this time.
Okay, so I'm going to skip through and talk a little bit about the process of life insurance, because I do think that is important, because some people, because they don't understand the process and they don't want to go through the process, if you will, of providing or applying for insurance. Let me say that. Then they get nervous about it, right? So there is an underwriting process as it relates to insurance. Generally, when you apply for insurance, there's an application that you have to take. When we take the application, we submit the application, and then our underwriting team takes over. Our underwriting team, they're gonna send you, generally we have a medical questionnaire that we ask. It'll be questions related to how much money you make, how you'll be paying for the policy. Will this policy be replacing another policy? We look at your driving record. Again, we look at your hobbies, your medical record, all of that. We ask for your doctors so that we can get a copy of your medical records. All of that becomes important. And the underwriting team then takes all of that information and they decide whether or not they need additional information. So if they decide they need additional information, then they may do what they also call a paramedical exam, where they will send somebody out who may take some blood, who may ask for a urine sample, who may ask you some additional questions about your medical history based on how you answered the questionnaire. And then once they get all of that information, they then go back and say, okay, based on all of this information, we will insure you at this particular rate. Could be preferred best, preferred non-tobacco, non-smoker plus, smoker rating, preferred smoker rating. It could be, they look at your medical records and decide what kind of risk you are. You think about this process the kind of way you think about lending when people pull your credit report and they determine what kind of risk you are to lend this money to. Well, insurance companies do a very similar process. What kind of risk are you to us to insure you? Because here's the thing, you likely are never going to pay more into that policy than you're going to get out of it for the death benefit. So the insurance company is taking on that risk and bearing that burden, and which is why they're saying we need to know what kind of risk we're taking on. So you go through that underwriting process. People don't always tell the truth when they go, but let me tell you, we're going to get your medical records. So if you're saying, I'm not taking any medicines, I'm not on anything, your medical records are going to say otherwise. So I always like to share this information to say, just tell the truth. Most insurance companies will still insure you, but now you may end up paying a higher premium than you want to pay, or you may end up paying a higher premium than was quoted to you because of what is found in the medical records. But it is always good practice to tell the truth, right? It's the truth that makes us free. And so you want to make sure you're telling the truth either way. And if you're unable to be insured, there are also companies who will do what we call guarantee issue, where they don't require you to go through an underwriting process, but trust and believe the premiums for the insurance policy where you are guaranteed issue policies are going to be much higher than going through the underwriting process. So I wanted to just kind of mention that as a way to think about it, because as you are looking at insurance policies and maybe even wanting to upgrade your insurance policies, because you can do that. Insurance policies are considered contracts. So you generally can never change the contract that you have entered into with an insurance company. But what you can do is replace one contract with another contract by perhaps taking the cash value out of the one, transferring it over to another one because you want the additional benefits that the other one will provide. It's called the 1035 exchange in the insurance world. And when you exchange that policy, you generally have to go back through the underwriting process again, but you may gain some benefits. You also may lose some benefits depending on the features of each individual policy. So those are things to kind of think about as to whether or not it is a good idea to exchange the policy depending on what your goals and objectives are. And I'll stop again now and ask, are there any other questions before I kind of wrap up my portion of the presentation, and then maybe we can open it up in general discussion.
There are no questions in the chat.
Okay, well, let me wrap. I heard the question asked about, how, do you need life insurance, and does everybody need life insurance? Again, I am a proponent that everybody needs life insurance well into your retirement and maintaining life insurance coverage. In our community, we know and see that we are unable to standard that we want to set. We are supposed to be leaving a legacy for our children's children. That is the standard. That is the biblical principle And I feel safe in talking about that here because we're in a faith-based organization. So the biblical principle is to leave a legacy for your children's children. Insurance is a way to provide that. I tell, I say this because I work with all kind of people across all walks of lives. And I have some single fathers who are not currently in their children's or engaged in their children's lives for whatever reason. And I say to them, even though you haven't been engaged in your child's life, all of their life, what a gift it would be that if and when something happens to you, right, they are the beneficiary of an insurance policy that you left. And people know that even though you may not have been able to be a part of their life while you were in the earth realm, you still thought of them, you still cared for them in a way because you left this legacy for them, right? It's an easy thing to do. I mean, when you think about putting a policy in place and making sure that you have that in place. The other thing that I hear often from people is, well, I have coverage on my job, so I don't need my own coverage. And I say to them, what if you're not working? What if you get laid off? What if the tides change? Because in those times, you are not covered at all. You have no coverage because you're only covered on your job when you're working. And it's generally only a portion of anywhere from, I've seen 2 to up as high as 5 times your salary. And is that sufficient? So that coverage that you have on your job should be considered supplement to what you plan for yourself and for your family. Everybody needs life insurance. Everybody needs to, we cannot build wealth in our communities. We can invest, and investing should be a part of our process of leaving a legacy, but it can't be the only way because we can't work enough and save enough to be able to leave the kinds of legacies that will be necessary to sustain our families for at least the 2 generations. So when we think about life insurance, I strongly encourage us to get it. I strongly encourage us to be intentional about what that coverage is. And I strongly encourage us to really be intentional, especially in these times that we're in right now, about making sure that your family's overall financial portfolio is intact, from your income and making sure you've got right beneficiaries on your jobs at work. Quick story, I have, and this has happened on more than one occasion, where, I have inherited some policies from here at Prudential, not policies of people that I actually, brought on, but they were given to me. And somebody passes away. Well, in this instance, I get a call from wife to say, hey, husband passed away. We want to know what we need to do in order to process the life insurance policy. So I do the research and I look, and wife that I'm talking to is not wife that's the beneficiary on the policy. This was his second marriage, and wife number 1 was still on the policy. Well, guess what? I couldn't even talk to wife number 2 because she was nowhere on that policy. Because remember, I said earlier, a life insurance is a contract. And so make sure your house is in order is what I'm saying. Make sure on your jobs, you've got your right beneficiaries listed with your HR companies. Make sure that on any other annuities or investment accounts or bank accounts, that you've got the right transfer on death, and at a minimum, a transfer on death. If it's a joint account, make sure it's listed as joint with rights of survivorship and not listed as you and somebody. Because if it's you and, then their half of it has to automatically go through probate, which could hinder you from accessing those proceeds to continue living off of while you go through this process. And so whenever we talk about life insurance, I always add those things as a means to say, y'all, we gotta get this in order. We gotta be intentional. It is the will of the Lord that we all prosper, and it is His will that we not be stressed out about money. He is our provider and our source, and He gives us what we need, but He gives us tools and resources in the earth realm to manage, to help make sure that our families are taken care of. And it is our responsibility, it is our mandate, it is our duty as we work to build His kingdom on earth as it is in heaven, to put these things in place. I'll stop talking there, and thank you all for this opportunity to share. Take questions if there are other questions, and appreciate you guys giving me this opportunity.
All right, Ms. Glenn, we do have another question. How old should we consider putting insurance, life insurance on our kids? So how old should the kids be before you put life insurance on them?
I am a proponent of doing that when they are born, because again, you guarantee their insurability. And if you do a permanent policy on them, then you set yourself up for being able to use the cash value buildup. Think about it. From 1 to 18, you're paying a premium into a policy. You're building up cash value. At 18, you generally will have their first year of college that you can pull out of that account, that first year of college, to do that. And you can do that for as little as about $300 a year, $25 a month. That's a $100,000 policy. And if you make it a variable death benefit, which means that death benefit grows with them as they age, you may have to pay $600 a year to do that, but you have guaranteed their insurability, and you have created something to pass on to them. Because once they get 18, when they are considered adult, I always say to my parents, don't transfer it to them until they're 25, but think about how that would make them feel that at age 25, because you put this policy in place on them when they were born, now you're transferring this cash value to them that they get to decide what they want to do with. Now, we would encourage them to continue to maintain it, but if they say, you know what, I want to cash this policy in and I don't want it no more because I got my own, then you have just passed on to them a part of your legacy for them. So I'm a proponent of putting insurance on children as young as possible based on what is budget allowable for you and your household.
All right, we have another question in the chat. So does the cash value you use decrease the policy?
It does not. Now, the cash value does have an impact on the policy, meaning that if you access that cash value, once you pull it out, it could mean that later on you may have to pay a higher premium or pay additional money into the policy. But that's where it becomes really critically important to work with I'm going to say an agent who is reviewing your policy with you on an annual basis to see how it's performing. Because its performance is dependent upon the market, you taking cash out of it could impact that policy in some way. But as long, in most cases, as that policy has some level of cash value, that death benefit will stay in place.
And we have one last question. Can you talk a little bit about mortgage insurance?
So we use the term mortgage insurance, but it really is just a term policy that covers your mortgage for that time period. So I think Mr. CJ was saying earlier, if you got a 30-year mortgage, you would get a 30-year term policy. Now, a lot of mortgage brokers, mortgage companies, sell mortgage insurance as if it is something separate from life insurance, but it is not. It is life insurance. And I want to be clear to understand that if you pay mortgage insurance inside of your mortgage payment, so for instance, a lot of companies will require you to have mortgage coverage. That coverage doesn't necessarily cover you, the borrower, it covers the company. So even though you're paying for mortgage insurance inside your mortgage payment, it doesn't cover you. It protects the company in the event that you default on your payments to them and they have to foreclose on your home. So you want to be clear about that too. When they're telling you that they're covering you and providing you mortgage insurance, that is not to cover you. That is to cover them. But you can purchase your own mortgage insurance, which is generally just a term life insurance policy that covers that mortgage for however long, 15-year, 20-year, 30-year.
All right, we don't have any other questions in the chat. Thank you, Ms. Glenn.
Thank you. It's
All
been
right.
a pleasure to share with you all today.
All right. Awesome information. Thank you to both of our speakers, Mr. Madison and Ms. Glenn. You guys were awesome. You brought out so much great detail that, you know, some of us just don't know. So feel free to please reach out to them if you have any additional questions. If you want to use their services, reach out to them. They're here to help you. If you have any questions for the Legacy Program, you can also reach out to us at legacyprogram227@gmail.com. Stay tuned for our next class in June. It's going to be Car Buying 101, and we will be sending out information for that. All right. Anything else? Any other last questions? All right. Well, thank you all again for joining us, and I hope that you enjoy the rest of your evening. Thank you. Bye-bye.
Bye, everyone.
Everybody have a great weekend. Great
You too.
Memorial Day.
Bye-bye. Great,
Bye.
great information.
Awesome information, guys. Enjoyed it.